If you like what you see, if I can please request you to subscribe to my channel. Have you ever wondered how investors quickly compare companies, even if those companies have very different capital structures? One of the most common tools used is the enterprise value to EBITDA multiple, often written as EV over EBITDA. Now let's break that down. The enterprise value, or EV, represents the total value of a company as if someone were buying the entire business outright. To calculate it, you take a company's market capitalization, which is its share price multiplied by the number of shares, and then add total debt, minority interest, and preferred stock. After that, you subtract any cash that the company holds. In short, EV equals market value of equity plus net debt. It's a more complete measure than just market cap because it includes debt and cash, giving a sense of what the company is truly worth to a buyer. Now let's consider the other half of the ratio, EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Essentially, it's a measure of operating performance. EBITDA tells us how much a company earns from its core operations without the effects of financing decisions, tax rates, or non-cash accounting items. Investors like EBITDA because it gives a clearer look at the company's underlying profitability, how much cash it might generate before the accounting noise. So when you divide enterprise value by EBITDA, what are you really measuring? You're estimating how many times a company's operating profit a buyer would have to pay to purchase it. For example, if a company's EV is $1 billion and its EBITDA is $100 million, the enterprise value to EBITDA multiple is 10 times. This multiple is often used to compare companies in the same industry. A lower multiple might suggest that a company is undervalued or that it faces higher risk or slower growth. A higher multiple might indicate that the market expects stronger growth or sees the company as safer. However, the EV to EBITDA ratio should never be viewed in isolation. It's best compared across peers or industry averages. Capital-intensive businesses like utilities or manufacturers often trade at lower multiples because their earnings can fluctuate with heavy depreciation charges. On the other hand, look at software or services companies. With lighter assets, these might justify higher multiples, reflecting their scalability and growth potential. An advantage of using EV to EBITDA is that it neutralizes financing factors. Two companies might have very different debt levels, but since their enterprise value includes net debt, the ratio adjusts for that automatically. It's also very helpful in valuing companies that don't yet have net income, since EBITDA can still be positive even if earnings per share are negative. Still, the ratio isn't perfect. EBITDA can overstate cash flows since it ignores capital expenditures, the real money companies need to invest to maintain operations. Analysts often pair EV to EBITDA with other metrics like EV to EBIT, price to earnings, or free cash flow multiples to get a full picture. So my question for the day is, what is the difference between efficiency and profitability?